Good afternoon. My name is Francisco Torres. I've been here once as Santander Fellow and other things a couple of years ago, and a pleasure and honor to start to listen to the inaugural seminar of the PEFM by Max and David. He gave the inaugural lecture, right, at that time. Yeah. And it is an honor and a great pleasure to chair this session, where PEFM Director Charles Enoch is giving us his presentation on the EU monetary and financial policies, the core and the periphery. Charles joined the political economy of financial markets program some 2 years ago, and then he became director last year, just following David and after Max, and is as well an associate of CSOX here at the house. And his CV tells us a lot. He has been at the Bank of England for a while, then he was seconded to the IMF as an alternate in the board. He went back to the Bank of England and then joined the monetary department of the fund. And then he stayed in the fund until the end, basically 2 years ago. He was even asked, he was to come here a bit earlier, just told me, in 2014, but they asked him to stay a bit longer. And he did so. So he came now to, after 26 years or so, at the IMF, came to Oxford, which should be heaven. Once Max was discussing the future of Minus, that would come out of the IMF, and says, after the IMF is what? Could only be heaven. So I guess it's St. Antony's. Well, Charles has studied at the other place, King's College. He did an MA in economics, and then he went for a PhD in economics at Princeton. So after that, he came back to England and joined the Bank of England. He has as well recently co-edited two important books, one in 2007, which is titled Rapid Credit Growth in Central and Eastern Europe, Endless Boom or Early Warning, and the more recent one, just 3 years ago, From Fragmentation to Financial Integration in Europe. So this is really on the core of the topic of today. So without further ado, I will give you the word. Thanks. For how long you will
talk? For, I don't know,
half an hour
half an hour, 30, 40 minutes.
40 minutes.
So, and then, yeah.
And then we'll open to questions.
Then we'll open to questions. See what we go through.
Oh, thank you, Charles.
Yeah, thank you very much, Francisco. Thanks for the introduction. Just to first of all say what I'm not talking about, although if one wants to afterwards in Q&A, we can talk about all sorts of things. European Union core and periphery is not particularly about Brexit. This started before Brexit was ever thought of. I mean, so Brexit clearly has impacts on many things, but it's not directly on Brexit. And it's also by the periphery, it is not the what's been interpreted as the periphery. I mean, the countries which got into trouble with after the Euro crisis and needed the bailouts. So it's not Greece, Portugal, Ireland. So Greece, I mean, to very simplify it, it's the ins and outs of the Eurozone. So that means that Greece and Cyprus are not in the periphery, and Sweden and Poland are peripheral countries. So that's basically the framework. So now hope you can read that. It's actually, putting this into context, going back now, this is actually a good time for regional economic and political unions. We're talking about the EU here, but this is a global trend over the last decade at least. And part of the reason is because of the failure of global initiatives. I mean, the Doha round, so the trade liberalization slowed down and stopped, and the Doha round didn't go anywhere, so the global initiatives were problematic. And the global institutions have been increasingly underfunded relative to what they've been meant to be doing. And there's figures for the IMF and World Bank where they have not grown in size relative to trade or to imbalances. And in fact, there's a study by Charles Whitplots and others which shows that the situation is going to get worse in 2022, since many of the funds are limited term borrowings, which will decline. So in a sense, the global institutions are not likely to be doing enormously well. So this then leads, therefore, we have, just to briefly go down these ones, I mean, another point here is the growth of the Gs. And the Gs are the group of countries. So when I started out, it was the G5. So just the US, UK, Germany, France, Japan. It became then the G7. There was the G10 at the OECD. And it got to G20, which some people think is great and fantastic initiative. But if you've got 20 countries in there talking, you've still got 170 who are not. And the more things go out from universalist institutions, the more that the 170 are important, the more they actually have things they want to say and do. So partly it's led to regional development funds, the growth of regional funds. Clearly the which I'm not talking about particularly, the EBRD, the EIB, and the Chinese ones. And a few of us were at the Chinese the seminar in St. Hugh's with the Asian Infrastructure Investment Bank, which already grows to be comparable in size to the World Bank. So a lot of regional initiatives. So we have the European Union here, Pacific Alliance and Mercosur. You have, therefore, Mexico, Peru, Colombia, and Chile coming together as, I mean, on the other side of Latin America from Mercosur. ASEAN, Chiang Mai, so Southeast Asia. You have then the African initiatives, YMU, which clearly is modeled on the EMU, so West African Economic and Monetary Union, and the Southern Africa ones. So this is basically, this is a growth there. A further factor leading to this sort of regional coalescence is nervousness after the global crisis, which was seen to have been partly resolved because of bilateral swap lines. So last time we could all rely on the Fed because we had Bernanke there. And there's a lot of, I mean, so Brazil and all sorts of countries are very rapidly put together. And there's a feeling that the present incumbents who are, I mean, Mr. Powell who's succeeded Janet Yellen, may not be so into it. And also, again, they do the swap lines with the big countries. But if you're not the big country, you're not there. And so you're nervous, and that's an argument for the regionals. And here we have just one of them. This again is Pacific Alliance, the 4 presidents there declaring their desire to integrate, particularly, they're starting on the capital market side, interestingly. It doesn't all have to be like the EMU, but they're starting capital markets. They integrate, their big thing is MILA, market integration of Latin America, where they're combining their stock exchanges. And another thing to stress is that it's deliberately open to the world. So it's not, I think, traditionally there's nervousness to the regionals, prevent globalism. These guys here, they want to be at the table. The point is to have a seat at the table, because otherwise Chile is not in the G20, and you wouldn't expect that Brazil or Mexico, which are there, would look after it. And so there's a point there. And these guys are observers to ASEAN, and ASEAN are observers to them. So the regional groupings overall are linked together. So we finally come to the European Union, which is longer established than these other ones now for since the 50s. And for the last 35 years, it's been for an ever closer union. So in that sense, it's got further than these other ones have done. The Stuttgart Declaration, 1983, and there was a German-Italian initiative. And it was a time of really exchange rate turmoil, when you had the exchange rate mechanism and periodic readjustments. And in a sense, the Germans, it was West Germany at that time, had to make more and more commitments to the rest of the ERM, particularly the Italians, that it's the earlier version to it will do what it takes. We're going to have an ever closer union. So this was then a forerunner. It therefore led to beyond, you broke through the European Economic Community and this side, and you went on from there. And forerunner, for instance, to the single market, where the UK then, sort of under Margaret Thatcher and the people she appointed, were very strong proponents of this. So what we saw in the European Union, on the one hand, it's the taking over responsibilities from the national authorities. And the other side here is also prospectively taking over from the global authorities. So the plans there, so on both sides therefore they're taking power, not just from the nationals going upwards, but they're taking it down as you know, for whatever reason, they no longer wish to be totally dependent on the International Monetary Fund. So talking about this, I mean, it's a long way to go, but it's sort of in the sights. Ever closer union. So Mr. Juncker continues with this. Europe 22, he's got various plans, but all of them are just further integration. And what do you integrate first, and how do you integrate it? And so the analysis, my point is the analysis is really on the core, on the integration. And there's lots of studies of the EU. A lot of them are now out of date. If you look at them, they really, so I think the peak of these was about 2000, 2010, a lot of integration studies on what do you integrate. And it assumes either everyone does it or everyone follows pretty closely. And however, the other increasing thing is one size does not fit all. And for those who've been around here a couple of years, will remember where they might first have seen this. This was from our former EU fellow here, Karl Falkenberg. This again comes from the Juncker 22 report. But it shows here that we're already deeply into a sort of spaghetti side. The core, as I define it, would be sort of the top left, the top left side there. The countries there which are both in the Euro and in Schengen. So that's the top left ones. The ones, as you move to the right, are also in Schengen, not in the Euro. The ones below, Cyprus and Ireland, in the Euro, not the other side. You move out then to the EEA and onwards really to 51 countries. And I would just sort of add that whilst, the Euro is clearly the most obvious of these things, even the outlying ones there, the Council of Europe actually impacts and distinguishes Europe from the rest of the world. For instance, Council of Europe means if you're signing up to that, you can't have capital punishment. It's just a thing which we, I think, here, so we live with and know this, and whatever the economic arguments, there's certain commonality here which is different from much of the rest of the world. So that's just one example. And the other thing, just the bottom right corner here, just as an aside, I'm not the first one to make this point, but if one's trying to restore, here's the UK wandering about, and who knows where it is, but if you really want to, bring back control, it's these guys, the bottom right, you need to worry about. Article 5 of NATO is that if there's any invasion of any of the NATO countries, all countries will mutually defend them. So the Russians send 3 troops into Estonia, or the Saudis 5 into Turkey, and the British Army goes there. And that's not under control, that's under treaty obligation, which, so if that's not a focus of the guys who want to make sure we can have our own water standards or whatever. So that's a sort of a Brexity type point, but anyway. So let's go on. There are now new models for the European Union. Just looking at one of these, and that is Pisani-Ferry, who has a number of hats. He's spent a long time in Bruegel. He's also in Sciences Po. He's also the Padoa-Chiopa chair at the European Institute in Florence. And some of this stuff he gave in his inaugural lecture. And he's also senior advisor to President Macron, which is why he's particularly interesting and relevant. And he has on a global view, it's a new architecture. It's not the sort of the big bureaucracies, but a whole bunch of specialist organizations such as the FSB, the Financial Stability Board, which therefore has a large grouping of countries who work together. You have share common values, but beyond that, you be following your own direction. Less emphasis on sanctions, he said, which is one of his points. It's really, how can we take things forward? Now, for the EU, he says he identifies 4 areas within which one can have variable geometry. So there's the economics, so it's all the Euro stuff, the fiscal stuff, and so on. The security, so defense and the European army, labor migration, this is Schengen and migration rules, and then other things which aren't there yet, sort of education and so on. That's an interesting framework. I think what I'm doing here is drilling down further so that even within there you do have, I think, more variable geometry than perhaps he envisages. but I mean, broadly though, this is a recognition that it's not one size fits all, that there are going to be different stages which one is at. If thinking back just now to the diagram we looked at, now only 17 of the 48 countries of the European Council are in the Maastricht Schengen zone. And even within the EU, 9 countries remain outside. And this is not likely to change rapidly, and would argue, and it seems to be recognized, that recognition of this diversity is to be analyzed and welcomed, because otherwise these other countries are just, drifting off. Now, the economic diversity, now talking about diversity all the time, I mean, this is a definite disclaimer, which one definitely puts in here, that there are certain minimal values. I mean, Hissam Ferri has the same point as well. There has to be underlying principles which remain shared across everyone. It's the liberal democratic values, the rule of law, European Court of Justice, and the 4 freedoms, which are goods, services, labour and capital, which may not be complete yet, but are aspirational, but works in progress. Probably a couple of years ago, one wouldn't have had to say this, especially not the first 2, because one would have assumed that these were in the acquis. But one is coming back further, and Hartmut and I, Hartmut's just had to leave, were in Budapest last week giving a talk, and really by our side was a representative of the Prime Minister's office who was giving a different view. I mean, this liberal democratic values, it was not necessarily held, so this is an issue. Okay, Maastricht, the ins and the outs. Under the Maastricht Treaty, 1989, all countries without an opt-out had to join the Eurozone once they satisfied the 3 conditions: central bank independence, inflation within a small range of the best performers, and debt below 60% of GDP. Problems. Firstly, these criteria are archaic. They come from the last millennium. The issues with them are inflation we haven't looked at for the last few years, and that's not a binding thing, and countries are trying to push up inflation. I mean, maybe we come back to another inflation time, but at the moment that's not it. Central bank independence, yes, it's great, except 2 things. A, there's difference between what the legal structure and the de facto and de jure, and this can be quite a significant one. And also the studies of the 1980s showing the dominance of central bank independence come under some sort of question when central banks are increasingly roles for bank supervision, bank resolution, all these other things, because at least for some part the situation has become more complicated. And the first one is the 60% debt limit. That might have been a nice number at a nice time, but as we'll see towards the end when I have some numbers, it's not really a valid criterion at the moment for who should be in, should be out. Next problem with Maastricht is unfair on new members. I mean, the Brits and the Danes could go and say we didn't want to do it and we got our opt-outs. Anyone who comes in now, you've got to take the entire body of the European of the EU law without any, which arguably is I mean, unfair and leaves for first class and second class citizens, and the new members should be full members in that regard. Nextly, political pressure for premature entry. When one has it that you're going to be going into the Eurozone as soon as you satisfy criteria, that of itself seems to imply that it's good to do so. And for countries which wish to establish credibility and so on, show that they've got great policies, they will go there, and they will be encouraged through fraternal help to get in there. So you have Greece, it's also some of the others, but most clearly Greece, where the numbers were not necessarily what we thought the numbers were, and probably everybody realized that. And there was these criteria were neither sufficient nor necessary, but Greece went in early into the Eurozone, and arguably, but it's not universally agreed, they've had bigger problems and had to do much deeper adjustment because they did not have the exchange rate tool. I mean, it's not the same as saying they should have left the euro. Once you're in the euro, you're in the euro. But had they been outside the euro, had they been like the UK, they would have been able to depreciate exchange rate, and they would not have had this depth of problems. The next one is the inadequate support structure, lender of last resort. There's lots of analysis that the Eurozone is only half a zone, and there's intrinsic problems with it, because apart from anything else, the lender of last resort, it remains national. So the countries do not have the whole point there, and anyway, there's also fiscal, there's endless problems with it, particularly that where you do the monetary leg without the fiscal leg, that maybe you need to do the whole things at once. So there are definitely part of the euro crisis is because the euro is not yet fully formed. And finally, the other one is economically questionable Italy. Again, this is an issue that, is it really useful? Should a country be in an fixed exchange rate system when it clearly has not converged in certain structural areas? Italy has not grown at all for the last 10 years or so. Arguably, at least one factor has been the constraint in the exchange rate system, meaning countries become increasingly uncompetitive vis-à-vis the best performers there. So these have been problems with Maastricht, and a number of countries stay outside it. Now, the reasons, which ones are outside? Sweden and Denmark are outside. They both had referenda, would you like to join? And referenda often have the answer no, so they didn't. The UK, with Gordon Brown and the Treasury, took a very optimal currency economic line, and 6 tests were introduced to whether the UK had converged sufficiently to join the euro, and Britain didn't pass those tests at a time when it's politically conceivable we might have joined the euro, so we didn't to that point. Countries not ready: Romania, Bulgaria, the sort of almost the newest members the newest bar Croatia, and they still are adjusting. And what is being argued is that it's not the Maastricht criteria which keep them out, because to some extent they actually have satisfied them, but it's the other sides of it, which are the non-economic sides, the money laundering, the corruption, which people are more aware of now than in these earlier times. And there's also ambiguity over the credibility gains. Early on, a lot of the new economies wanted to join the euro because you have the euro premium. At that stage, very quickly, interest rates fell in countries joining the EU, joining the euro. It's ambiguous whether that was good, because it led to credit booms, as in the book which you referenced to. So massive increase in credit then, when in some of Central Eastern Europe you had low interest rates. So it was because there was overachievement of credibility. Everyone assumed when you're in the euro you'd be bailed out, which ultimately wasn't the case. It's also the fact that, the second one is that there are studies showing there has been relatively limited convergence. The euro of itself does not produce real convergence very much. Again, the Italy example, that Italy is as converged to the central countries, the Benelux, Germany, as before. This euro itself does not produce convergence. And you've got some countries, particularly the Czechs, who say they don't need the credibility gains because actually they're performing better than the euro countries. So Czech interest rates actually at some times are below euro rates, so why should you go into a worse performing ones? It's no longer the euro, it's the best performing. Some of these countries do underperform, partly because the euro is a composite of great and not so great performers. So all of these mean that there's not necessarily a rush from all these countries to go in. Others do rush in. There was another conference and the Croatians there said, yes, we're going in the first minute we can, because they maybe still need the credibility and wish to demonstrate that they're performing very well. So in practice, the criteria are not binding. There's more of a choice than one would have thought if you just read Maastricht. But a counterexample is that some countries are unilaterally going in. Montenegro, for instance, has unilaterally adopted the euro. Again, it needs credibility. It's a new country. It's surveyed by all sorts of external forces. It doesn't have much independent policy power anyway at that size. So you do have countries which go in, but others stay out. Now, how to avoid being in. So this is how you wish to avoid it. If you decide you do wish to not be in the ever-close union, firstly, you get the legal exception. The Brits and the Danes were on the ball in Maastricht and said we didn't want to do it. Doesn't mean you have to stay out. You can withdraw your derogation. The Brits also had exemption from the Labour part of the treaty, and that they gave up the derogation because under the Blair government, we're happy to accept that. You can game the criteria, which is what Sweden does every year. The central bank every year is deeply upset when it gets a communication from the Treasury, from the Finance Ministry, instructing it to do something with the reserves. And so, you've got to put 25 million of reserves here, and they say, shock horror, we're not independent. And there are little footnotes, in the ECB annual meeting saying that Sweden technically doesn't meet the independence criteria, which, again, is that really a great criterion if you can do that? You ignore the rules. New members have no scope for derogation. We had the Czech deputy governor here last year, and he said, we're not joining, and we don't think we're going to be sued by the EU telling us to. So, okay. And also the other thing, it's not on this, but on a lot of the parts, is that actually, whether you comply, whether you do these things, there's not yet uniformity on some of the underlying plumbing. On the accounting rules, the enforcement, the implementations, there is still, when you're in the details, there is still diversity. Now, we move on then to the banking union. So that was the recent one. This was in the middle of the crisis, as banks were getting into trouble in Southern Europe, the Eurozone crisis. There was then the European Council decided they would make a banking union, which would include a single supervisory mechanism and also a European stability mechanism. The European stability mechanism was talked back very soon afterwards, particularly by the Germans, who were not so happy with what was committed. But the single supervisory mechanism did go forward, is now operational. The countries in the Eurozone have to join, and is optional for the countries outside. NB, as of today, not a single non-Euro country has volunteered to join this. Now, the single supervisory mechanism is located in the ECB to avoid treaty change. This is because in the middle of crisis you didn't want to have treaties, because this would therefore lead everyone to raise new issues. Under Article 239 of the European Union Treaty, the ECB can also do any other thing it's told to do. So it's a block thing, you can add things to it, but at the time of Maastricht, probably very, very, very few people ever thought it would be the supervisor. If you went to talk to the ECB and its earlier incarnations in the 1990s, they wouldn't even admit they're doing any banking work. That would be moral hazard. And so to then become the single supervisor, but that happened. The Germans were not necessarily happy, and Schäuble, the finance minister, said it's a timber-framed banking union. It has certain weaknesses in it, and you really need a steel-plated one. Some of the constraints of this mean that we have a timber-plated union which can survive certain storms, but even Mr. Schäuble wonders what sort of storm it can survive. Although not all countries have joined it, all EU countries are affected because they all have banks from these countries. So there is participation in the SSM, it's relevant. And however, one would just note there's still diversity within the banking systems, even for countries within the SSM. Germany has a very large number of small banks. France is much more centralized. The SSM deals with the biggest banks, so it has a larger share of some countries' banking systems than of others. Now, the arguments to remain outside. There is a two-tier structure in that the Euro country banks are the only ones for which the ECB actually has direct powers. All decisions of the ECB have to be the governing council. That is only covers the Eurozone countries. So if there are decisions on non-Eurozone countries, there is again a sort of clever fudge, whereby the decision is taken in a different committee which would include them all up to the final stage, but then you have a final ratification at governing council. But the problem is that if you're a core country, a non-Eurozone country, you are not at the final stage. So maybe you don't want to have your banks discussed then. Second thing, again, the banking union is incomplete. As we know, there is no lender of last resort, and there's no deposit insurance. Again, these are works in train, but there is pushback against establishing these. Only the largest banks are supervised directly by the single supervisory mechanism. Those over, I believe, $3 billion, pounds, euros, and also the 3 biggest in each country, and those with significant cross-border exposures. So what's meant to be the systemic banks, they are there, the others are not. So some countries say, well, you know, why should we do a 2-tier structure? We may as well stay out. Also view that maybe local supervisors are better than the SSM supervisors. The SSM supervisors, the pooling of the supervisors, the main advantage is meant to be better governance from the ECB and best practice filtering down. On the other hand, they may be overworked, and if you're a Spanish supervisor going into Finland, are you really going to do better than the Finns? For the Finns, they stay out, but are you going to do better than the Swedes? The Swedes may think they can supervise their banks better than the others, and there's concern at maximum harmonization. This is across a range of EU issues. Maximum harmonization on the banking system is that all banks have to achieve a certain specified minimum level of capital, and there is mistrust of countries which try to impose higher levels of capital. And this was a big issue between the Brits and the others, where the Brits said we wish to have high levels of capital, and the Commission and others said, no, that's just gold plating, that is not single market. If you're being pure single market, you have the same level of capital, you have the same requirements, you cannot have tougher requirements. So others who say you have a race to the top, I mean, there is tension there. And some would say the minimum level of capital EU-wide is just because that's lowest common denominator. It's what the weakest bank systems can do. And so the Brits and others, the Swedes, very strong at wishing to have higher levels of capital. So there's a tension there, so if you avoid these guys, maybe you wish to do so. Now, you need protections for minorities. If it's just going to be just the Eurozone and everything's created because they do have a majority, it's really not necessarily going to be great governance. It's not going to keep the others terribly happy. So what in the EBA, the European Banking Authority, I hope I'm not using too many of this alphabet soup, that is the single regulator for the whole of the EU. So it's a single market, single banking regulator. However, up to now there's been a double majority. If something passes there, it's got to be the Eurozone and the non-Eurozone. This is a British suggestion, so you need a double majority, otherwise won't. As the UK leaves, if the UK leaves, the imbalance becomes greater and it becomes harder to maintain these protections for minorities of the smaller minority, which is a concern to them. You have super majorities. I mean, some things are just one person, one vote, and 51% you're done. But a lot of them are weighted voting, and you need larger amounts than that to get things through. And there's a counter-argument that this causes paralysis, and it's very easy if you wish to rubbish this process, saying, yeah, it's just, you know, the outs, the ones who are not committed to the Euro project, trying to stand in the way. So again, this does cause some sort of tension. Moving. Sorry? Yeah. Oh, okay. So what's integrated? I mean, what's integrated in the EU? Let's see where we are in the EU at the moment. For certain things, there's single currency, there's a single system, you have entry conditions, you've got derogations. There's only one European currency, which you may or may not be in, and that is the euro. It's also, there's one data system. So, you know, Eurostat, you sign up for that, and there's no derogation from that. Now there's some where you have pan-European Union regulation and supervision. And the main one there, which is meant to be a prototype, is sort of stuck there, is ESMA. That's the European Securities Markets Authority, which, like the other authorities, is a regulator, but they have a limited direct supervisory power, which is particularly the credit rating agencies, because nobody was really supervising them at all, so they directly regulate, as well as trade depositories. And there's all sorts of things about DG Comp, which one could spend the whole time talking about, because they have similar issues about how to get round the independence, not treaty change, but they run things through, and they are the participants of the troika in the restructuring. So they are quite significant. Pan-European regulation, the EBA regulates the banks, IOPA regulates insurance, occupational pensions, ESMO regulates securities markets. You have a single rule book that's across it. That's essential for single market on the EU's side. Then you have certain things where there's just rules for the euro area and volunteers. I mean, the single supervisory mechanism we just talked about. And what's not integrated, you're still national. You have supervision itself is within the EU regulatory framework, but the smaller banks are nationally supervised. Out of the 6,000 banks in Europe, the single supervisory mechanism supervises about 120 of the 6,000. They cover 82% of all assets, but the bulk of banks, which are concentrated in a small number of countries, are not supervised by them. They're national without a framework. We've got macroprudential, which I'm going to talk a bit about in the next few minutes. Then you have an EU framework. There is a framework that's not implemented and not necessarily harmonized yet. Accounting standards, everyone's meant to be an international accounting system, and they're getting there, but it's not fully there yet. So non-performing loans traditionally have been measured differently, as we saw recently with the Italian banks. And then you have very, very early EU framework, which is the fiscal compact and other things which are not fully consistent and haven't necessarily gone so far. In theory, subsidiarity is a principle which the Germans put forward in the German constitution. I think subsidiarity is there. This is certainly a British overarching thing. Unless you find a good reason to centralize it, you keep it at local level. You have that, but it is answered by the guys who say we need more Europe, not less Europe every time there's an issue. So again, this is an ongoing tension. So some areas, let's just quickly note that some areas have integrated beyond what the Euro area has done, the EU. So Scandinavia, they've had Nordic councils, Nordic meetings, all these other things. However, Finland's in the Euro, Denmark goes to the Euro, Sweden's outside the Euro, and the other two are not in the EU. But nevertheless, they have close links. And then we have the other one, just to mention, which is the UK and Ireland, which is in a quasi-Schengen, and there's free movement of people across. When we get to 2030, we don't know where we are going, because it could be, the only one which is probably certain is air will be in the Euro area. Scotland, the rest could really be anywhere, so we'll see where this happens. Now, let's have a
Can
look.
you just say
Yeah,
one point
I can
detail? At present, between the UK and Ireland,
Yes.
if you're an immigrant from Iran,
Yeah.
and you get into, you're admitted to Italy,
Yes.
can you book a plane ticket to Ireland?
Yes.
And then drive across the border
Yes.
to Northern Ireland,
Yes.
and then get a ferry to England?
Yes. Yes.
Why isn't this talked about every day as being important?
It's sort of gradually is becoming. I mean, it's yes. But I mean, the
Many of us travel by train from Brussels to
yes.
London.
And you don't show a passport. Oh, you do show because we're not in Schengen.
No, there was a way of declaring that you were getting out halfway on the train and going through the different routes.
Okay.
And you just stayed on the train and landed up in London.
Yeah. But it's a serious issue as we come through to the backstop and how you go. How is it possible to maintain an open border if you have different, perimeters, and if it's I think becoming apparent you need to be in the customs union and in a single market. Otherwise, you need something. Everyone is trying to fudge if you don't do it at the border, you do it in the Irish Sea, or high technology, you do it from space. But
It's just, sorry. I didn't
I shouldn't have jumped over the thing. I was just trying to. Scotland clearly it'll be in the EU, non-euro. If Britain doesn't Brexit and always come back by 2030, and Scotland's still part of it. Britain could be still in the EU or could have come back. Could go into the EEA, Canada plus, or off the cliff and just underwater, and who knows. And Northern Ireland could be anywhere, I mean, where it is. I mean, they may ultimately decide to join with the Republic, or they may follow the UK, Britain off the cliff. So we watch this space with excitement. Now, let's go look at the future as where we might be going on this. And one thing I think is quite interesting is the macroprudential policy structure, what's been set up there. Partly, this is new. Macroprudential really hadn't been thought of until about the Mexican crisis, first financial crisis of the 21st century. So there's little baggage. You can start setting things out de novo. It really is quite new, as opposed if you're doing central banks or finance ministries. I mean, you've got your Bundesbank, and you've got your Banque de France, and you've got your other stuff. But this thing you can set up new. Macro-pru is hugely, hugely important. It was macro-pru failures which led to the global and the euro financial crises. So it's important to get this right. I mean, it's new and important, and people are learning it. So and macro-pru is multi-dimensional. It's not like monetary, where you just decide this is our currency, this is our interest rate, one decision. And it's predominance of soft power, partly because one's not yet fully certain where one is, and because it's multi-dimensional. Increasing recognition now, as you're setting up something new, of the requirements of good governance. You need technical independence, transparency, accountability, accessibility, inclusivity, parsimony, and efficiency, which are all good things, and things that institutions are judged on those. And I mean, the European Union really are world leaders on this, because they have looked at this, and the structures they've set up, others are following. Now, you have the European Systemic Risk Board, which brings together all the parts of the financial sectors. You've got banking, insurance, securities regulators, and authorities from all the European Union countries. Not a euro, it's an EU. Point, it's very easy to rubbish, and people do, because it's big and unwieldy, but maybe you need that. The location is at the ECB, which again has pluses and minuses. The plus is it has huge resources from the ECB, and the ECB people have done a lot of their work. The disadvantage is it's not independent of the ECB, and again, if you're an out, you might seriously worry about this, because there are linkages, clear linkages to the ECB and to being in Frankfurt. However, there is leadership amongst the non-core. The chairman of the ESRB is the head of the ECB, so it's Mario Draghi. The deputies have come from the outs. So it was Mervyn King, it's now Carney is a deputy. And also they have two very strong outside bodies which determine their view, which is the Scientific Committee, which is really an A-list of European monetary academics, and they revolve around, and an impressive body of people, 15 of them, who do a lot of research work on this. And there's an advisory technical committee. And this was headed by Stefan Ingves, again an out person, who set a lot of the agenda for it at its time. And there's presence also, a full presence almost, of the non-EU EEA. And this is partly, I think, Stefan's due, because he comes from Sweden and the EEA guys are around him. So they sit in on it and actually have a formal role. They can do everything except vote. And what's interesting also here is that policies, everything we have here is a union of nations. When you get to this group, they don't have the Union of Nations. If the macro-pru do not cross, are not consistent with just national boundaries, then the policies, if you decide that commercial realty is a macro-prudential risk, then you could have, take measures or recommend measures against that across countries. The first warning which these guys did was against foreign currency borrowing, especially in Swiss francs, where, guys, you must realize the interest rate looks as though it's 1%, but the Swiss franc's appreciating. So these measures really affect certain groups in a number of countries. Or you can say shipbuilding is a concern. So in that sense, it could be a vehicle whereby you can move beyond, in some ways, from national policies up to pan-European wide policies. And question is this a revenge of the experts? Michael Gove said we had enough of experts. I mean, this is really experts and technocrats throughout. I mean, none of these guys is ever elected by anything. but maybe in some ways that do that. And whereas civil society, I'm not sure, that may be more of something there. Here, this is the group. They are, again, easy to ridicule. With this group, this is the general board. They meet quarterly. They have an immediate press notice, so they do try meeting civil society. They are transparent and accessible in that you can sort of understand what they're saying. The governing board has 39 voting members and 32 other members. The steering committee, which determines how this goes, is 14 members, each of whom represent constituencies. The academic technical committee has 68 members, and the steering committee is 15. So it is complicated and rubbishable for that, but I think that's one of the strengths. So they also have now, amongst the various things, I'll just go very briefly what they do, they have a risk dashboard. So if you want to know where the risks are in the country, they produce this every month. They discuss, this is what the board discusses. Is there a risk? What should we do about it? And you'll see these are all results of academic research over the last 30 years, or some basic concepts. There's 70 indicators to tell you whether Europe is in crisis. So all these different ones here. So you discuss this, and clearly the steering committee determines is there something here we should look at. So it really is a highly technical exercise, which maybe is the way you bring Europe together. You bring Europe together at a very highly technical level, bring in all the members. I'm just showing 3 or 4 of the slides. Here, this is the current and forecast real GDP growth. You see Ireland here is growing more rapidly than anyone else. I don't know if you can read it. Ireland's on the left. On the right, the furthest on the right is Denmark. I'm not sure why. And then Italy and then the UK are the slowest. So everyone ranges around there. Now, this next one here is quite interesting. This shows the Maastricht criteria. This is debt ratios to GDP at the moment of various countries. And you can see that virtually all the countries with debt higher up on the left violate the Maastricht criteria. Hence, if it were today, they wouldn't be accessible, wouldn't be allowed to get into the EU, which of course includes France, Austria, Greece, Italy, Germany is just in. And so basically the UK is also above there. The countries which are below, which could actually get in, includes countries like Bulgaria and Romania and Denmark who are not in. So it's almost a perversity here, that you find the countries which are in have higher, and this is partly because the criteria are obsolete and because the debt ratios went higher up, partly, but it's nevertheless a reflection of where we are. This is a more interesting, this is probably the sort of thing they would actually look at and discuss at the board. This shows here that the lightest one is public sector debt, is what we saw on the other side. Then you have household debt, and the dark brown ones is the corporate debt. There's the middle one without the brown in the middle, if you can't see, is the UK, and it says there's no corporate numbers, which I'm not sure why. But it shows the UK, even just with those two, is quite highly in debt. In fact, has the highest household debt, of any of them. So this is really the sort of the warning thing which they'll look at. To what extent is their debt? Does it matter if it's private sector debt? The countries on the left are a bit different from the other ones. You've got Cyprus and Luxembourg are the two most indebted. And is that therefore because it's sort of, does it mean something else? I mean, is it really they're offshore centres? There's a lot of discussion one can have on that. Sorry, this is the last one of these. I would have this again shows sectoral issues here. If they wish to be pan-territorial and sectoral, this is lending for house purchase, because there's lots of analysis that most crises come indirectly or indirectly from house price booms, which is excessive credit to the housing sector. And the biggest biggest one here, the left-hand one is Denmark, followed very rapidly by the UK. In the 3rd and 4th place, you've got, Malta and the UK there. So again, high. But again, this is structural and requires sophisticated discussion. And here, this is more systemic stuff. This shows that it's a composite of systemic risk, which shows the scientific and another one here. These are the CCPs. So again, it's not just national. These are the central clearing, centre counterpart clearing houses. As part of the response to the global crisis, you now have to be transparent, and all trades must be on central counterparties, but they themselves, therefore, are now risky, have huge systemic risk. And so these guys also look at, again, getting beyond the national. Okay, coming to conclude. So what are the questions here? Whoops, twitch. How far is their scope? This is really the non-core countries. If they come and think about this and what they wish to do they actually have scope for diversity in exchange rate and monetary policy arrangements? De facto, yes. De jure, no, which is not terrific for governance, but that's it, unless you have the derogation. Why should a country not join the SSM, and how is it affected by the SSM? The main reason to join the SSM is you're at the table. And if most of your banks are foreign banks anyway, or subsidiaries of foreign banks, you wish to know what they're talking about it. However, that's not been sufficiently convincing to get any of the non-euro, of the non-core to join. They're all staying outside. Is there any common ground about the non-core? I mean, can you really get together? Can you form a discussion so that you have some balance against the view of the core? And that's problematic because of the so-called illiberals. You have the Visigoth Four, who sort of the Poland, Czech, Slovak, and Hungary, who have worked together, and they have certain things where they would not wish necessarily be fully aligned with the Swedes and Brits on some of the fundamental values, which maybe makes it more problematic. Our relationships in the Scandinavians affected by policies, not necessarily, we've just seen there's a huge range of them. Is transparency a universal value? I mean, I think yes, but there are certain parts of the ECB and the structure which is not fully transparent as yet. So conclusions. Governance arrangements need to reflect the ever closer union is an oversimplification, and the outs will persist. And protection needed for the outs, just because more countries do something else doesn't mean that you don't need some protection. You need equal rights for new entrants. You cannot distinguish those who are in the EU at Maastricht time from those who are not. Basic values, whatever it is, we've still got to have rule of law and ECJ and these other points, which can be a challenge really to the basics. And recognition of the outs. One point which is here, if the ins recognize the existence of the outs, they can go forward with an even more core group of ins. And here I think I differ from Pisani Ferri at the beginning, who says, hey, you have variable geometry, so we just have the outs, so therefore we can go on and we can do our fiscal union with the outs. I mean, maybe those who want the fiscal union will again be a subset of this core, because not all these 19 will or should go into a fiscal union, but if Macron wishes to do it with 4 or 5 countries, that would seem entirely appropriate. But again, this idea of the diversity and the multidimensional is helpful even for the ins, as the ins wish to get further in. The final slide here is, the EU is not a behemoth. There's considerable variation amongst the ins, amongst the outs, the strength. Important for members, new members, to be at the table. This is a big thing for them. That's why the EA countries want to be there, why SSM countries might wish, why non-Euro might wish to be in the SSM. Many areas work in progress, and I think, for instance, the Capital Markets Union is early, and macroprudential. Integration may lessen the role of the nation state, because economically some things are not synonymous with where the national boundaries are. The ESRB, I think, is a possible model in some ways. I think one should consider moving the ESRB away from the ECB and possibly ultimately SSM, so they're self-standing in their own rights, will be able better to deliver for everyone. And at some point, it'd be good to have a treaty change. There's now longer since the last treaty change than there conventionally has been, but there's been a reluctance to open up a whole range of other issues, so we stay with our timber-framed union. But maybe one day we can have a treaty change. And with that, I've probably spoken too long. Thank you.